A very good day to my lecturer. My name is Vinod Loganathan with the matrix number of S60408, and I am doing case 2 for the financial accounting and reporting individual assignment. So this is my case study. So A is required to get to see the total finance charge and the effective interest rate. So the total finance charge, where we can see is the present value of the total payment is 220,000 ringgit, where the cost of vehicle is 200 ringgit. So the finance charge can be found by subtracting cost of vehicle from the present value of the total payment, which will end up with a finance charge of 20,000. Next is the effective interest rate, the EIR, where you have the cash inflow is 44,000 5 times. Then the cash outflow for the first is 200,000, and on the most right is the net cash flow. So how do you get the net cash flow? Is by the cash inflow minus the cash outflow, and you will get the net cash flow. And also this 200,000 is the cost of the vehicle. So this will be the total for the cash inflow, which is 220,000, which is the present value of the total payment, and the cash outflow, which is the cost of the vehicle. So the EIR, or the effective interest rate, will be 5.01%. Then we could go to the next question. Requires us to prepare the lease receivable schedule, where when year 0, which means at the starting, the opening balance is 200,000, which is the value of the vehicle, and then the lease payment is 44,000, and your closing balance is 156,000. So how do you get the closing balance? Is by the opening balance plus with the interest income and minus the lease payment. So you would get the closing balance. So as the years go further in the first year, second year, third year, fourth year, the closing balance decreases gradually. So how do you do this? Is your how do you get the interest income? Is by your opening balance times your EIR, which is 5.01%, and you would get the interest income. So eventually it will end up with, on the fourth year, you would be done. So it will end up with a 0. Then the next is preparing the journal entries. So the first one is the record sales of vehicle, where it's paid in cash. You debit cash and you credit motor vehicle, which is the value of the vehicle itself, which is 200,000. Then you next one is to record the receivable on hire purchase. There is when you debit lease receivable, which is 220,000, and then the cash that you have paid for the vehicle, which is 200,000, and the unearned finance income, which is 20,000. And this is to recognize the receivable on hire purchase. Next is the record of the upfront payment from the customer, so which is paid in cash, which was 44,000, which is the year 0. There was a payment of 44,000, and the lease receivable, and this is to record the upfront payment from the customer. Next is record the interest income at the effective interest rate. This is it repeats every year, as you can see on the last day of the year, which because there are 4 years. So all 4 comes with unearned finance income, which is from the first year, as you can refer on this table. Then you credit interest revenue, which is the same amount as well. So that is all on my case study on case 2, and thank you for listening.